Hello, everyone, and welcome to another episode of the MaxProf Podcast. The topic today, VAT Apportionment. I know it sounds technical, but it can have a massive impact on entities' financial status and all of their finances. So, if you're involved in finance, this episode is worth watching. Joining me today is our Audit Manager, who recently wrote an article about apportionment, Mthokozisi Gumede. Mtho, thank you for joining us.
Thanks, brother, for having me. It's nice to be here.
Good. So your article, it got me thinking recently. The turnover-based method, most people accept it as the norm.
Yes.
But your article probably questions whether it really reflects reality or not. So tell me more about that.
Yeah. Being a norm, it is exactly that, because it's a standard recommendation by SARS through the binding general ruling 16 and 4. Right, so 16 being for all vendors, 4 being for municipalities specifically. So those two rulings then prescribe the turnover-based method as the standard method for apportioning input tax.
Right.
Yeah. So it being a norm would come from that.
Right.
Yeah. So then the article basically explores: is it still practical and beneficial to vendors? Looking at their financial conditions applicable at the time, especially for municipalities. Yeah. So that's basically what the article is putting forth, to say, just reassess it. Is it still most beneficial, practical? According to the VAT Act, the method must be reasonable, must be fair, right, and must not materially distort the input tax that is recovered.
I'm going to stop you there quickly. And I know at the beginning I said this can be technical, and it started off quite technical as well. Maybe let's just track back, and just for the benefit of the guys who are wondering, what is apportionment? So in as simple as you can explain it,
Yeah.
what is apportionment? Why does it exist?
Yes.
Why is some of the input not claimable? Just give us a brief something brief on what apportionment is.
Yeah. So apportionment, the whole concept behind apportionment is that, from SARS's point of view at least, so if an entity is not making 100% taxable supplies, the input that supports the making of the taxable supplies, if it is not 100%, so the input should then also reflect the taxable supplies. So you're looking at if an entity has mixed supplies, taxable supplies and non-taxable supplies. So then SARS will say, okay, cool, the input that would result from the cost that you incur for you to run this entity, for you to be able to make the supplies in the first place, that input tax must reflect the nature of your income streams. So that's the idea. So if you're not declaring let's say 100% on your output tax, then you should not be claiming 100% on your input tax, which in the input tax coming from the cost supports the making of the supplies, the enterprise of the entity.
Okay, and then what type of income are we speaking of here? Say, okay, I know your article did focus on municipalities. So for a municipality, their income streams, what are they, and which ones are taxable and which ones might be exempt or out of scope?
Certainly. So for instance, for a municipality, you're looking at supplies like your electricity, your water, your refuse removal, those kind of supplies. They are standard rated, so they'll be taxed at 15%. And then you will get grants. So traditionally grants are perceived to be zero rated until SARS recently came with a different story, basically picking apart some of the grants and saying they are not so zero rated.
Would that affect the apportionment ratio though? For example, if a grant was not zero rated anymore, but now standard rated?
No, it will not. But then the classification would not. Classification.
But not really affecting the
The
percentage.
ratio itself, no, it would not, because both are standard rated and zero rated are taxable supplies
Just at a different rate.
at a different rate, exactly. So when you have one at 15%, you have one at 0, but then it is still taxed, just like a percentage of 0.
So you can claim the full input VAT on a zero rated.
exactly.
So something like fines or interest,
Yeah,
for example,
yeah.
if that's quite high, it would lower your apportionment.
Exactly. And how that happens is by inflating the denominator. So the standard method is basically a formula. It has a numerator, it has a denominator. So all the supplies would form part of the denominator, and then you have your taxable supplies being your standard rated and zero rated supplies being the numerator. So when you have high interest charged or received, and your fines, so it will inflate the denominator and then resulting in a lower percentage.
Okay.
Yeah.
And so again, municipalities, what makes them, or why are they affected by this rule or formula
Yeah.
versus reality sort of scenario that we have going?
Yeah. It's a bit technical now, because we'll have to look at the accounting basis of a municipality. So for VAT, a municipality will be registered normally at the cash basis. So that is to say, VAT must be accounted for at payment basis, based on what they actually pay and what they actually receive. So that becomes the basis of preparing the VAT ones, right? So while the standard method would use information from the financial statements, so which are compiled on an accrual basis. So immediately we have a mismatch.
Efficiency method.
Exactly. VAT ones are prepared on a cash basis. Ratio is basically prepared on accrual basis. That's the problem. So you're gonna have, for instance, items like high interest rate, high interest amounts. Most of it being basically accrued, not yet receipted. Exactly. Especially for municipalities, you're looking at entities that are struggling to collect their debt. Most of it is interest, right? So that's how that distortion comes about. To say VAT is on cash basis, and then the ratio is prepared based on accrual, essentially. So yeah, that's the main issue that municipalities are facing with this method.
So it kind of distorts their ratio, almost, one can argue, sort of unfairly.
Unfairly, exactly.
You correct me if I'm wrong. Didn't SARS with the fines bring in something where you only need to disclose the actual fines received on your apportionment ratio and not the fines charged? Because obviously fines is something that people generally don't pay. So is that not something that could be applied maybe to the interest?
And you see now, that's exactly what we need. So if we can have such a provision applied to interest, to say, well, even for interest, can we include interest that is actually receipted? And that's basically part of one of the things that the article is proposing, to say, can we explore alternative methods? And the first one that we prescribed in the article is a modified turnover method. So we're not saying the method is wrong. It's fine. It's a very sound method, practically easy, administratively it makes sense. It's easy to verify because it's based on financial statements. However, can we modify some parameters, at least in as far as it concerns the formula itself? So can we include interest that is receipted just for
Actual receipt,
exactly,
just like the fines.
just like fines? Yes.
Yeah, it's a nice point to put out there, and I think with hopefully a lot of engagement through channels like this, views and opinions of all the experts out there will also weigh in and give their opinions. Okay, so we've spoken about interest, the fines, and tell me, another interesting point in your article was donations.
Yes.
What sort of issue does a donation cause on your apportion situation?
Donations are a huge one because for municipalities, you would have donations in the millions, hundreds of millions. Sometimes,
Example, what could be?
so you're looking at, for instance, a donation of water infrastructure, moving from one entity, municipal entity to another, you see, or government entity to another government entity, that the other being the municipality. So you're looking at a movement of hundreds of millions, and it can be a once-off transaction. But then now, so what you are sitting with in the financial statements is, for instance, 200 million of donations received. Now, in the formula, that will fall in the denominator, basically as an out-of-scope item. So what it is going to do is inflate the denominator by 200 million. The result of that will be a materially lower rate for that year. But then you're looking at a once-off transaction. Yeah. It's a once-off transaction. It's not necessarily, a municipality is not in the business of receiving donations. So exactly. So then there must then be a provision to say such once-off transactions that are going to materially distort the rate, can they then be excluded? Not unless it can be supported that such transactions are now basically part of the enterprise activity of the municipality. So from that point onwards, that the municipality is expected to have that kind of a transaction. Until then, it just makes sense to reduce it.
I hear you.
Yeah.
So we've raised some issues. We've raised some points in your article of what perhaps could be done or should be done, certainly. Possible solutions or alternate methods of calculation, but these are just sort of ideas. What can an entity actually do? What can a municipality actually do in order to propose this or get this implemented?
Exactly. So you have Section 17 and Section 1441B of the VAT Act. So these two sections allow SARS to approve an alternative method, and they allow a vendor to apply for an alternative method, in which case then SARS has the allowance to approve it. So practically, if an entity or a vendor observes that the current standard method is not the most beneficial given the actual financial conditions, what they can do then is make a submission to SARS, asking to change the method into a proposed alternative method. Yeah. So there's a provision. The two provisions in the VAT Act are Section 17 and 41B. So what you're looking at then, an entity needs to basically compile in statements, just at a high level, the nature of the business, the entity. So now you're looking at a municipal entity. What kind of services is the entity basically providing to the community, the scope, the reach. So a classification of the income streams. So it must then classify all the income that it receives. So between standard rated, zero rated, exempt, out of scope, and non-supplies, right? So and then also how are they generally utilizing those resources? This is part of the submission that they must do. And then lastly, they must then do a comparison between the standard method and the proposed method. So they must basically say, okay, on the standard method, this is the ratio that we get for this particular year, 2025-26. But then on the proposed method, this is the ratio. And then this is the...
It really reflects a bit more fairly.
Exactly. Yeah. So, yeah.
It sounds good and easy. But I think to implement it, you're probably going to need some sort of expert opinion, expert advice. That's to get your allocations correctly.
That's why you have MaxProf.
Yeah, that's the question. Yeah. Who comes to mind when but you answered it already. So just as we finish off, if there's one thing that a CFO or a finance professional or anyone from the or anyone just watching, is one thing to remember from your article or from
Yeah.
this podcast, what would that one thing be?
In summary, one could say to management of especially municipal entities, mainly being our clientele, consider the cash implications of the VAT apportionment method that is being used. Because when you have a lower ratio like that, that means you're gonna recover less input tax. That means less refunds. That means less money in the bank. That means less resources available for the activities that the municipality needs to do. So providing services to communities, the paying of salaries, the ability to employ personnel that will assist the municipality to grow and even collect their debt much better. So the impact of having less money in the bank is huge. It doesn't only affect municipalities, the customers, being the community members, they get to suffer because then now the municipalities are unable to provide services sufficiently. So really the impact of this is quite far-reaching. It's one of the ways in which we can improve the cash flow position of municipalities. They are struggling. It's a nationwide known fact. Yeah.
So in short, cash is king.
Cash is king in this case. Yeah.
Okay. Thanks, Mtho.
Yeah.
I think if the viewers found this podcast valuable, please share this episode with anybody that you might think would be interested in it. Like the MaxProf YouTube channel and follow and keep watching for more podcasts.
Yeah.
Thanks, Mtho, again for joining us. Thanks, bro. I hope you join us again soon.
No, definitely. Thank you, man. Sure.